Are you considering buying a whole life insurance policy or perhaps have a financial advisor who suggested it? Well, keep listening as we talk about the pros and cons of this product and a cheaper alternative that may be better for you instead. Hello, and welcome to the Wealth Minded MD podcast with your money best friends. I'm Dr. Brittany Helford.
And I'm Dr. Alicia Taylor.
And of course, we're here to help you build wealth and make good money decisions so you can create the life you desire with more control over your time. Leisha, can we talk about life insurance for a second? Because I feel like this is one of those things that people either avoid or overcomplicate.
Exactly. And honestly, a lot of us think we need these big, complicated, expensive policies when in reality, most people just need a solid term life insurance policy that actually protects their family.
And that's why we love working with PKA Insurance Group. They're independent brokers, which means that they're not tied to one company. They shop across all major carriers to find you the best option.
And what I really appreciate is that they're not trying to upsell you. They'll actually tell you what you do need, what you don't need, which is rare in the insurance world.
Exactly. Whether you're getting coverage for the first time or you already have a policy, they'll review what you have and let you know if it's solid or if there's something better or more affordable out there.
So if you've been putting off life insurance or wondering if you actually have the right policy or if your current policy is a good fit for you, this is your sign.
Reach out to PKA Insurance Group at pkainsurance.com or call 1-800-258-1018 to get started. And don't forget to tell him that we sent you. Also, the link is right in the show notes for your convenience. So click the link and get started today. Well, Leisha, in the past episode, you were talking about how you're trying to figure out your trip because of all of the craziness that's going on in the world. Girl, okay, we're not even going to talk about all the craziness, but clue us in if you figured out an approach. What's happening?
I think by far, I have spent more hours planning and navigating the logistics of this trip than I have any other trip. And that is saying a lot because I travel a great deal. But I started planning this trip like a year in advance. And I will do like an entire episode of how I planned this trip. Because for a lot of people, going to the Maldives is like a bucket list. Oh my God, 10-year anniversary trip. For a lot of people, it's very expensive. And for us, it was not a cheap trip, but we certainly did it a lot cheaper than maybe the average person and still included in some luxury experiences. But girl, yes. All right, let's start with the fact that at the time of this recording, there's a war in the Middle East. Let's just start there. For those who have never been to the Maldives or aren't familiar with where it is on the other side of the world. You can't just book a United flight or a Delta Airlines flight from your city in America to the Maldives. That is not how it works. Usually you have to book it on an international airline that flies to the Maldives, and Delta is not one of them. I live in Atlanta, so that's kind of a big deal because Delta's our big hub. And so usually you have to book the flight on these international airlines. And the international airlines, from my understanding, that fly to the Maldives are airlines like Emirates, airlines like Etihad, airlines like Qatar, and all three of those fly through the Middle East. So if there's a war going on in the Middle East, it's kind of like, well, I would like to not die on my way to vacation. So I wanted to understandably avoid the Middle East. I mean, the only airline that I was aware of that avoided the Middle East and would still get me to and from the Maldives was Singapore Airlines because it flies through Singapore. And I had already booked Singapore Airlines for our flight to the Maldives, but I had booked a different airline on our return flight. So I had to pivot, if you will. And that means I had to book backup flights on Singapore Airlines, try to find good flights. I'm a little bougie. I don't like sitting in economy, especially not for a 15-hour flight. So it's like, what are we gonna do?
A little bougie.
Girl, this is a 15 to 17-hour flight, depending on which way you're going. And I'm like, I don't think I've been on a plane for that long. That is a long time. The whole day gonna pass. We're gonna eat breakfast, lunch, and dinner. Like, what is happening? And just be sitting upright, especially if you're in a middle seat. Like, girl, no, I cannot do that. My back cannot do that at this stage of my life. I refuse. So I was on the phone with Singapore Airlines, like, please find me a flight. And they're like, we have economy. I'm like, girl, not economy. You gotta find me something else. And then they're like, well, it's gonna be $1 gazillion. I'm like, like, okay, so something else that's affordable. Let's try to think of these creative solutions now. So anyway, the agent, God bless her heart, because I was definitely pushing her. I know she was ready to hang up the phone on me, but we ended up piecemealing together a flight where there's like one portion of the trip, like from the Maldives to whatever the regional hub is, that's like 4 hours. That part is an economy, but the other part is like in premium economy. And then she was telling me how I could upgrade. So anyway, we figured it out, but it took lots and lots of hours. But yes, planning the flights was just one part. We decided that we wanted to spend a couple nights in Singapore on our way to the Maldives. So just trying to figure out what hotel are we staying at and what do we want to do. And then once we get to the Maldives, what do we want to do when we're there? So yes, lots and lots of planning for this Maldivian trip. But I am excited, girl, because as the time of this recording, we are about to go in a few days. And after all the planning and all the money, I'm like, girl, I need a vacation now. I need a vacation from planning the vacation, let alone all the other life things that have been happening in the midst of this. So, girl, I'm ready to let loose.
Well, Leisha, I just commend you. I really do. As someone who am not a travel planner, like I just cannot do it. So the fact that you did it, the fact that you figured out, you're like, I'm not going to give up on this. I'm going to still make sure that I'm safe, make sure that I can enjoy the experience and take in everything that is happening around me, all of these other external environmental factors that I have to now incorporate in the planning so that I can accomplish those goals. I commend you. Yes, please do a whole episode. And I mean whole from like beginning to end. Okay.
Noted.
So you said it's a whole year. So don't make the episode too long. But we still need the details.
Noted.
So thank you for sharing that. And I'm appreciative that you got an agent who is willing to work with you, willing to be creative, and willing to hear your concerns because that is not always the case. And the fact that you're like, oh, I'm going to the Maldives and I need to fly at least business class, or whatever. It's like, girl, you're going to the Maldives.
Look, I don't spend a lot of money, but I do splurge on travel, okay? But I do have a limit to the splurge. So I'm like, girl, we got to think of something else. I know you got something else in that catalog. I'm going to need you to look again. She was like, we don't have anything available. I was like, have you tried this?
And we wish we would have recorded the conversation because we want all of those little nuggets to ask us alternative suggestions as we're working on booking our own trip. So, all right. Well, that is super fun. In this podcast episode, we are not going to continue to talk about the Maldives as fun as Leisha has already introduced to us, but we will talk about something that is dear and near to my heart, honestly. And so I thank you, Leisha, for going through and saying, yeah, let's do an episode on this piece. And that is whole life insurance and index universal life insurance. And the reason why I wanted to talk about this is because it is impacting me personally. It is impacting my family. It impacts a lot of us. And when I say us, I would say like low middle class individuals, those who grew up in like ethnically minority family. Because what I see happening too often is instead of purchasing term life insurance that has a fixed period of time, people who have certain demographic characteristics purchase a whole life insurance policy. And we're going to talk about the differences between all the types of policies. And when I hear it, it just makes me cringe a bit because I personally don't think that whole life insurance policies are the best policies for us. Or for most people, actually. But we'll talk about some of the benefits and drawbacks of that. So let's just jump into the basics. Leisha, take us through term life insurance, because, that's kind of what we promote on this podcast. And then I'll tell you a little bit about my experience with whole life and how to define whole life insurance policies. But start with the term life insurance. This is the one that I have. Leisha, do you have a policy?
I do. I just got a policy. So we'll have to do an episode on why I got it and what I went through, but not now. Anyway, let's start on life insurance, right? So life insurance is an insurance policy that you purchase not for yourself, but for your family. It is a policy that kicks in after you pass away. So if you were to pass away, if you have a life insurance policy, then ideally the insurance company would give money to your family or to your heirs or whoever you designate as your beneficiaries of that policy. So one thing to note is that life insurance is not for you, it's for your family because you've done passed away. So you're not benefiting from the life insurance. Let's just put that into perspective here. So if you were to pass away, the insurance company would give money to your family or to your beneficiaries, to your kids, etc. So if you are somebody who has a family that would be in need of that money, then you might want to consider a life insurance policy. And one of the things that I'm always talking about to my residents, to medical students, to early career attending physicians, and just to people who maybe are not in the medical field is you first got to ask yourself, do I need life insurance? And I know a lot of people, their default is, well, yeah, of course, everybody needs life insurance. And I actually don't believe that that is the case. Life insurance provides money to your heirs if you were to pass away. But some people, such as myself, maybe you have lots of family and friends, but nobody is dependent on you financially. So if you were to pass away, they would be sad, but they wouldn't be in a financial crisis because maybe, like me, no one in my family depends on my income. When I get paid for my job, nobody has their hand out saying, give me a chunk, give me a chunk, give me a chunk. There's nobody that I am financially supporting right now. Conversely, Brittany, I know in your situation, you've got a spouse and 2 kids. And so although your spouse might be fine by himself, you've got kids that you want to financially support. Maybe you were planning on paying for their college. Maybe you need to pay for their daycare, etc. Or even though your husband does work, maybe you all bought a mortgage and made investments predicated on a dual income. And so if one of you were to pass away, it's like, well, how would we pay our mortgage? How would we pay our bills? So the question to first ask yourself is, do I need life insurance? Is there somebody that is dependent on my income? Oftentimes, if you are married and if you have children, or if you financially support your extended family members, then that answer might be yes. But if you don't have kids and you're not married and you don't financially support extended family members, then you may not need life insurance. So that's question number one. Do I need it? Do I not need it? Question number two, if I need it, what type do I need it? And I think that is the premise of this episode is if you need life insurance, what kind should you get? Brittany, you mentioned that you and I are really big advocates of term life insurance. What is that? So that is life insurance that covers you for a certain term or time period. And usually that time period is until you turn 60, 65. And so people who are 30 years old, for example, maybe they might take out a 30-year term life insurance, in which case, if they were to pass away within the next 30 years, that insurance policy would kick in and provide money to their family, their heirs, their children, or whatever. If they were to pass away after that point, then they would not get a benefit. And so for a lot of people who maybe aren't as well versed in the finance space, they hear that and they go, how is that good for me? I want something that's going to cover me no matter when I die, not if I were to pass away within the next 10 years or 20 years or 30 years. And one of the points that I want to make crystal clear is that for a lot of people, that term life insurance is still sufficient. And let me tell you why. Because most people, if you have a career, especially if you're high income or whatever, most people are investing some money in their work retirement accounts, whether it's a 401k, a 403b, maybe they've got some sort of IRA, whether it's a traditional IRA or a Roth IRA. So you've got some money that's being invested on your behalf. And so the thought process is that by the time you turn age 65, that money has been investing and building and accumulating over time. And so if you were to pass away in your 70s, then the money that you have in your retirement accounts, you should be able to suffice and you should be able to give that to your family. Also, if you're 70, chances are your kids are grown. Although they might be sad if you passed away, they may not be financially dependent on your income. Usually, a lot of people, their expenses have drastically changed by the time they've turned 65 or 70. And so, for most people, what they really need is an insurance policy to cover them and their family during the term or the time period in which they are working and still building wealth. And usually that is for the next 10, 20, or 30 years. So long story short, a term life insurance policy is a life insurance policy that covers you for a certain term or time period. And usually that term or time period is 10, 20, or 30 years.
Awesome. All right. Now let's talk about permanent life insurance. And this is where, Alicia, I don't know, you come from like a financial family background, but this is where I go head to head with my mother all the time because she wants to ensure, she has all the best interests at heart. My mother, I love her to death. She asks great questions, always very curious. So she wants to know, well, Brittany, I want my family to be protected at all times.
Mhm.
So I don't want something that's just going to last 30 years, right? She wants to have this reassurance that her family is protected. And so she wants a permanent life insurance policy. And these typically are designed to last your quote unquote whole life and to build a cash value component over time. So a lot of times when this is touted and sold to you or to anyone as a product, they say, well, yeah, this is going to last your entire life and you're building cash value. So you can borrow from it if you want during your lifespan. And they're like, oh, yeah, this is great. I'm not losing quote unquote money because I'm putting it away and I can always use it at any point in time. And when I borrow from it, I just got to pay myself back with the interest. Like it's not really hurting me. But the problem with whole life insurance is, yes, it has a fixed premium. Yes, it has that guaranteed cash value growth, but it is expensive. And this is where I think for us, where it becomes a bit more of let's make the math, because we have to think about when you have a permanent life insurance product, what are they doing with your money? And so let's just take the whole life insurance option and now talk about another insurance option. When you have the whole life insurance option and you have these fixed premiums, oftentimes what that insurance company, in order to give you that fixed premium and that guaranteed cash value, is that they're using that money and they're investing it in another something. And that something is giving them some type of growth. And then they're using that high premiums and oftentimes investing it. And that is helping you to build up this kind of guaranteed cash value. But on the other side of that, the premiums are so much more expensive. If you would just think like the bank, then that would allow you to invest the money instead and take a term life insurance policy and have the difference, that difference of the premiums that are so much more expensive. If you just took that money and you invested it, then you would get a better return. So then the companies know that and they're like, okay, well, let's now maybe sell you this permanent life insurance policy, give you more of an investment piece. And so that's where the index universal life insurance comes in. And that is a cash value that is also tied to a market index. It could be marketed as like a S&P 500 or something else. They will give you some type of guaranteed fixed rate in addition to the cash value that you're building up in your whole life insurance policy. But there's a floor, even though they're investing it, you can't lose money. So that sounds like a really good option because you got the best of both worlds. You get some type of investment benefit, and then you're also building up the cash value. The problem with these products, and we'll go in more detail, is that you really shouldn't mix any life insurance and investment product. So the Index Universal Life gives you kind of this additional guaranteed boost, or even sometimes it could be variable depending on the product, variable rate that is tied to an index or tied to some type of market standard. It also gives you that permanent cash value. But these products are expensive. And if you think like the companies that are selling you the products, the insurance companies, they are taking whatever the cost of insurance is plus whatever additional margins they have, and they're investing that. And so what we're saying is if instead you take the cheaper product option or a shorter term, and then you invest the money and get higher returns, you're actually going to be better off because you're not at this fixed low rate that is quote unquote guaranteed by the permanent life insurance.
Yeah, I think one of the things to know is that for a lot of people, as we just said, term life insurance is sufficient. And I think one of the reasons why is because it's so much cheaper. I wouldn't have a huge problem with whole life insurance products if they were affordable. The problem is they're very expensive. And then a lot of the folks who sell these policies try to justify the price by saying, oh, you can build up this cash value and it's going to be indexed to the market. So your money grows as the market grows and that sort of thing. And they will talk to you about the bells and whistles of, oh, you can borrow from it and those kinds of things. But let's just start from the basics. For most folks, if you're getting a benefit of the same amount, if your death benefit is the same amount, meaning once you pass away, how much is the insurance company providing your family? If you compared $1 million policy when you pass away of term life insurance to $1 million policy if you pass away from permanent life insurance, more times than not, the permanent life insurance product, the whole life insurance product, the index universal life insurance product is around 10 times more. So somebody might be paying $100 a month for a policy that would pay out $1 million if they die versus somebody else who has whole life insurance might be paying $1,000 a month. And that is a big difference because my experience, Brittany, I don't know if this is your experience as well, is that a lot of people who are buying whole life insurance and paying $1,000 a month, they usually got other better uses for their money. Maybe they're not even maxing out their work retirement accounts where they get a match. Maybe they've still got 6 figures in student loans that they've got to pay down. Maybe they're still saving up for a down payment on a home. Maybe they've got other expenses. And so one of my huge issues with it is that it's so darn expensive. And then you highlighted one of the other issues is that the way the cash value works and how it's tied to the market. My experience, I don't know if this is your experience as well, Brittany, is that oftentimes what happens is that whenever you are mixing investing and insurance, right, whenever you're doing that by buying one of these products, you usually get a subpar product of both. You probably usually don't get as good of insurance or as good investing. And the reason why I say that is because in a lot of these whole life insurance products, index, universal life, variable, universal life, however they're doing it, and a lot of these, shall we say, permanent life insurance products, the death benefit is usually not as big as you could have gotten with a term life insurance policy. Usually the death benefit is much smaller. Problem number one, meaning your insurance benefit is not as big. And problem number two is the amount that you're making and investing is not as much. Usually, I don't know if this has been your experience, Brittany, but they will show you these graphs and these charts of, oh, look at how your cash value will accumulate over time. But what they don't emphasize is that this is a prediction. And usually there should be two predictions. One is the worst case scenario and one is the best case scenario. In my experience is that most people's reality is somewhere in the middle. And usually when you look at how the cash value will accumulate over time, it is not as high as if you were to just invest that money on your own in an index mutual fund. For example, most index mutual funds in the market, S&P 500, total stock market index fund, those sorts of products, usually they earn people an average of 8 to 10% per year. I find whenever people buy these index universal life insurance policies and they're looking at how the cash value accumulates, it's usually more around 4%. So you're getting way less growth on your money whenever you try to invest inside of these permanent life insurance products. Plus, you're paying a lot more for it. Most people would be better off buying this cheap term life insurance policy and investing the difference on the side index mutual fund. That way, if they pass away during the term, they get what the insurance would have paid. And if they pass away after the term, they've invested that money over time on their own and they can give their family that money. And so I love what you're saying here is that, hey, there is a cash value component, but it is not as good as it's cracked up to be. Yes, some of them may have some guardrails in place, but despite those guardrails being in place, oftentimes you would do much better if you did not try to invest inside of an insurance product. And if you instead let the insurance product be just that and let the investment be just that instead of trying to combine them together.
Yes, yes, yes. And Leisha, one of the things that you said in the beginning is this life insurance is for your family. And that resonated with me, not just as a young 40-year-old with a husband and two young children, but it also resonated with me as I think about how I have helped my grandparents to navigate the situation. So that a whole life insurance is for your whole life, that you have some death benefit. But at some point, you expect those kids to grow up. You expect them to have their own homes, their own jobs, paying for their own bills. And so if the life insurance is for your family, do you really need the life insurance when your kids are fully grown professional individuals? No, you really don't, And so as you grow into your 80s, your 90s, and you're still paying for this insurance that has a low benefit, maybe 75,000, maybe whatever you get, then you think, well, actually, do I need to continue to incur this cost? So I want to take a step back and share a little bit of a personal experience that happened is when you have these whole life insurance policies, they're sold to you by a broker. And this is for both old and young, because I've had clients, coaching clients who are young, who have had this happen to them. They sell you an insurance policy and then they go away. Maybe they transition jobs and you are trusting the broker, but then the policy is with a different company and you have a difficult time communicating with that policy, or they sell your policy to another company that you know nothing about. And this has happened with a client who is in her 30s, who bought a policy because she had children young, etc. And now she's like, oh, I'm trying to cancel it. I'm trying to understand what is the policy about? What are the benefits? How do I navigate the situation if I want to cancel it? And we'll talk a little bit more about what you should do as we go on in this episode. But she didn't even know who to call because the person who sold her the policy no longer works for the company. And then they sold the policy to a different company. So she spent literally hours on the phone trying to figure this out. And the same thing has happened to other loved ones in my family who have now grown into older years and reconsidering, is this as valuable as it once was? This is really important because when we say whole life, if you actually want to get the benefit of the insurance, you have to be able to navigate that process. And what I have found in my personal experience is that it can be quite cumbersome because it's such an extended period of time that there's a lot of turnover and no one really knows all of the details. The other thing, there are many things that I want to say on this, but the other thing that I want to just highlight as a danger is the cost of insurance. And the cost of insurance often never stops rising if you get an index universal life insurance. So cost of insurance. So every permanent policy has a cost of insurance. This is what they actually charge you for your death benefit. In And whole life insurance, typically it's pretty smooth. It's a fixed premium, so you don't see it. But if you are in the index universal life insurance, then these charges often continue to rise as you age, and they are pulled directly from your cash value every year. So if you borrow from that cash value or something changes as the index does not perform, and so you get 0% returns, now the cost of insurance is increasing every single year, and you're trying to pay for your insurance from this cash value, but then your cash value is lowering, getting smaller and smaller every month. You cannot afford the insurance anymore because you don't have any cash value to pay for the cost of insurance. And so therefore, in your 80s and your 90s or whatever, when you're on a fixed income, how do you keep this policy going for your entire life? And this is one of the dangers that I see many elderly people often facing.
Yeah, I find, Brittany, that these products can be so complicated. Oftentimes, when they're sold to you, they're made it to seem like it's simple. Oh, we're going to cover you for your whole life. And then the benefit is you can borrow against it. Don't you want tax free wealth? And then no matter what time you pass away or how old you are, your family's going to get money. Don't you want to protect your family? Right? They're kind of sold that way.
Mm-hmm.
But then when you look under the hood, you see that there's all these fees and all of these things, and it's subtracting from the cash value, and the death benefit is changing in some of these policies. If you try to get rid of it, there's these large surrender fees and all of these things. When you look at how the cash value is accumulating, you will find out that oftentimes you don't break even until the 15 or 20-year mark. What does that mean? That means perhaps you're paying a premium of $1,000 a month, for example. And then when you look at your cash value a year later, your cash value may be $5,000. And you're thinking, wait, hold on. I paid $12,000 into this policy. How is it only quote unquote worth $5,000 right now? And that's because there's all of these fees and all of these things tacked onto that policy that it takes so long to even break even, which is one of the reasons why we say, hey, maybe you'd be better off with the term policy and investing the difference. So I want to make that clear, is that sometimes these policies are sold to be very simple. And when you look under the hood, they are not very simple. The
Mm-hmm.
other thing I want to mention is a lot of people purchase these policies because of the quote unquote cash value and the ability to borrow against them. And I want to make it crystal clear. Usually when you pass away, it's not like your family is getting the death benefit and the cash value. Usually it's just the death benefit. And then, yes, you're borrowing from it, but you're borrowing your own money. So if you had not purchased the whole life insurance, you would have had the money in the account in the first place. Like, I'm not understanding this. And then you're nodding your head, Brittany, as I'm dropping these gems. And then if you were to borrow from your cash value, sometimes it subtracts from your death benefit. So if you actually were using it as an insurance product to provide money from your family, the amount they get is much less than the amount that you thought, because they have to accumulate for any cash value that you already took out of the policy. Anyway, my point is that these things oftentimes have a lot of nuances, and the insurance agents and the companies have gotten real smart, and they've tried to structure these different products in different ways. But our point here is that oftentimes the benefits that are touted to you are not as good as they make them seem. This whole borrow against yourself, this whole tax-free wealth, it's like, yeah, you can borrow the money tax-free, but you're also borrowing your own money, which you could have just had access to had you not purchased this policy. And then also, when it comes to like borrowing this money, there's all of these other things that are kind of tacked on and drilled inside of the policy that you really need to pay attention to. And so for people who are worried about taxes, I think there are better tax efficient investing vehicles, starting with your work 401k and work 403b. The money you put in there, you put in tax free and it grows tax free. That's a pretty good tax benefit if you ask me. Your Roth IRA, especially if you're doing a backdoor Roth IRA, that's a pretty good tax vehicle. And so for a lot of people, if you're not already maxing out your work retirement accounts and doing your backdoor Roth IRA, or if you make 1099 income, opening up a solo 401k and customizing, those are the things you should probably be putting your money into first before you even consider the whole investing through a whole life insurance policy. So anyway, obviously I could talk about this all day. I will spare y'all. But yeah, those are some of my thoughts about this whole borrowing from the policy thing.
Yeah. And the saving piece, right? If you just save the difference, then you wouldn't have to borrow from it is so, so important, even as you're thinking about the index universal life insurance. Because after reviewing, multiple policies, I'm like, oh, they're giving you 4%. You could have made 4% in a high yield savings account. You could have made much more than that if you would have invested it. And there are creative ways where you can give yourself that guaranteed return on investment without the risk and without the hassle. So I just really want to emphasize that. And as you continue to pay this, you might realize that you have paid so much more than the benefit. I see that people pay for insurance and then they think that they're building up all of these benefits and they've paid $20,000, $30,000 more than what their death benefit will be. So this is something that really is near and dear to my heart. And I think that oftentimes we as a community sometimes, and if you're listening, everyone knows for the most part who are our listeners, but I'm a Black woman. And so I think that sometimes Black people are targeted. And it's a lot of unlearning that we have to do because our parents have used whole life insurance policies and they purchased them for the babies. As soon as a baby is born, then a whole life insurance policy is often purchased. So we kind of have this legacy of this is one of the ways that we protect our families. And what I would encourage you all to do is to have a conversation, to look into this yourself and to question, well, when I am 80, who's going to help me to manage this? Because sometimes you can't. And then if they don't know about this policy, your beneficiaries, then they may miss out on this opportunity. And so whole life is to protect your family, and you really want to ensure that it's doing that. Now, if you already have one, which I know many people have, and you're questioning, like, well, my mama told me that I should get this. What should I do now? Because I hear what you're saying and I trust you, Alicia. The first step is to ask for an in-force illustration. An in-force illustration basically shows you what the cash value is, what the death benefit is, and it projects your payments into the future. And this is really critical for me as I was helping many individuals kind of to navigate this process to understand in year, whatever it could be, 10 years down the road, what is going to be that cost of insurance? Do I want to pay, in this person's case, it was like $9,000 a year for this insurance policy just to get me this death benefit? And it just did not make sense. So after you review the numbers, not just the numbers today, but the numbers in the future, because remember, this is a whole life insurance policy. Does it make sense? Does the math over your lifespan make sense? And Leisha talked about that break even point also. If you're new into this policy and you still got to get to 10 more years before you even break even on where you are, does that make sense? And then I would also encourage you all to talk to an independent broker and understand what it would look like for you to get a term life insurance policy. What would the cost be? Would you be approved? Because for a term life insurance policy, you have to undergo medical underwriting. And I recently did this when I reshopped my life insurance, and we'll do a whole episode on that process. But I was a bit concerned because now I had two babies, right? It was a little bit challenging for me to get the first policy because of a condition that I had to explain, et cetera. And so it may not be as easy for you to get a term life insurance policy if things have changed in your medical history. So you really just want to compare the cost and ensure that you can still be insured with a term life insurance policy given your mix. Leisha, do you have any other thoughts about what someone should do if they already have one?
Yeah, I think what you mentioned was so critical because that sheet that will help you determine whether you should keep it or dump it is called the in-force illustration. Again, that's called an in-force illustration. You can ask your financial advisor who sold you the policy, whomever sold you the policy for that, because you've got to then do the math. One of the things I tell folks is the decision of whether or not to get a whole life insurance policy is very different from the decision of whether or not to keep a whole life insurance policy that you already have. So our point of this episode is like, hey, if you haven't bought life insurance, please consider term life insurance and then just invest the difference in your work retirement accounts or your IRAs or your taxable brokerage accounts. But if you have already purchased the policy, now you've got to make a decision of, is it worth it for me to keep it at this point or should I dump it? Once you get that in-force illustration, you can look at what is the worst case scenario, the best case scenario, what your break even point is on the cash value and make that decision. But if you've looked at it and you're like, yep, I'm not going to break even for another 10 years, and I don't want to pay another $1,000 a month for the next 10 years. So what do you do at that point? If you quote unquote surrender the policy, which means you're trying to give up the policy, oftentimes there's a lot of hidden fees. And so the cash value that you currently have is not what you're going to receive from the insurance company. So what do you do at that point? How do you prevent yourself from quote unquote losing money? One of the things that you can do is transfer that policy into a type of annuity. Usually it's like a fixed deferred annuity or a fixed index annuity. And it essentially will allow you to sort of build back up the cash value in it. And then once you reach your break even point, then you can surrender the annuity. And so there's sort of different products, if you will, or things that your financial advisor can help you do. One of the things I want to mention here is that if you've got a financial advisor who sold you a whole life insurance and you're listening to this episode and you're like, yep, I did not need whole life insurance or my policy sucks, you probably don't want to go back to that same financial advisor to help you fix this issue. One of our supporters of the podcast is Ben Martnick and his team at Bonafide Finance. His company has a tax side, but they also have a financial advising side. And so don't hesitate to reach out to Ben Martnick at Bonafide Finance. He'll be happy to help you kind of fix this issue or take a look at your policy. Because again, you might be listening to this saying, Alicia, this sounds great, but there's no way I can do that on my own. I don't even know what math you're talking about. Never heard of the words enforced illustration. I don't even know how much cash value I have. This might be the opportunity for you to maybe reach out to a trusted financial advisor and just have them help you take a look at the policy. That's actually happened to one of my colleagues. He had a whole life insurance policy. I took a look at it and said, this is not good. So he needed to get a different financial advisor. And when he did, that financial advisor first said, well, let's make sure that we get you a term life insurance policy to make sure you're covered. And then once he got approved for that term life insurance policy, then he surrendered the old whole life insurance policy and went on about his merry way. And that might be the case for you as well.
Yeah, Alicia, I really support what you said and looking at the benefit of the policy, how the policy is invested and how you could better use your money to get more return or to cover some of the cost of those surrender charges. Another thing that I mentioned is like making sure that you have some life insurance coverage because you may still need it, right? If you have a husband or a partner and you have young children. And I recently reshopped my term life insurance with Pradeep Auto at PKA Insurance Group. And he helped me to make that decision. So even though I had a term life insurance policy, I got a new one and then I canceled the old one because it was more affordable. And this was a decade later. You have to go through the medical underwriting. So a decade later, you would think that it would be higher for us to get a new policy, but it was actually more affordable. I got a bigger death benefit. So doing both, and I think working with a financial advisor to understand some of the investment piece, to understand the surrender charges and all of that, but also ensuring that you still have that life insurance, the term life insurance, and using PKA Insurance Group can help you to do that. All right. Well, now let's talk about some fun money. Alicia, I always want you to go first because I don't prep my brain for fun money. I need to write things down before. But tell us, how are you spending your money for fun?
Well, I think I mentioned that I am going to the Maldives, right? And all the plight that I have had trying to plan this trip. But one of the fun parts has been trying to spend some fun money while I'm there. And so reserving some spa treatments for a massage and making some restaurant reservations. There's this restaurant that's on the water in the Maldives that I cannot wait to experience. There's one that's sort of in the forest, if you will, with beautiful scenery. There's one with this Michelin star chef. And so how am I spending my money for fun? Girl, getting massages and eating. So I'm very, very excited.
Yeah, that's a great way to spend your money. I have not purchased these tickets. I probably need to do this now. But I have been thinking about, I don't know if you've seen the display of, I think it's called Xin Yun. It's this Chinese performance group where they have ballet and gymnastics and all of this artistry. So I've seen it on my Instagram about 10 times and they're actually coming to Boston. And I really want to see the show because the precision of how they're dancing and just the artistry that is displayed is phenomenal. So that's how I'm going to spend my money. It's purchasing those tickets for our children. Whenever we go to performances, they are locked in and they're overwhelmed with excitement and just amazement at how people can contort their bodies and to move and make it all come together. So that's what I will be spending my money on.
Noted. Okay. You got to let us know how the show is. I'm excited for you.
Thank you. All right, people. So hopefully this episode was not too triggering. I know that it can be for some people. And what Leisha and I, our goals are always to make sure that you are informed and making wealth-minded decisions with your money. Hopefully we accomplish that. And we look forward to seeing you in the next episode.
Hello, everybody. It's me, Brooke. I'm recording a little disclaimer for my mommy, Dr. Brittany Halford, and her friend, Dr. Lisa Taylor. Just so you know, they're not financial advisors, tax professionals, lawyers, or financial planners. Everything you hear is for education and entertainment. It's not strict financial advice, So use your best judgment, chat with a tax professional, and all those other people that you need to talk to. Thanks for tuning in today. Keep cruising on your journey to wealth and wellness. Bye-bye.